Welcome to this basics on the Forex trading. Right. So basically, Forex, what does it mean? It basically means foreign exchange. And this is foreign exchange for currencies being done by businesses, banks, governments, and some speculators like us. So I think since the gold standard was dropped, basically the value of a currency uh, floats, right? And that basically means that the value of a currency is being determined by the international market or whatever conditions the market, whatever price the market deems it uh, to be valued. So now there are two major kinds of forex trading activities which happen. Number one is institutional, which is mostly done by the big banks, and then we also have the exchange-based, which is mostly done in terms of international remittance, in terms of business travelers, and it's also done by you can say retail traders like us. So, what is the advantage of foreign exchange market or for forex? Why will somebody like yourself decide today that I want to become a forex trader or I want to trade in this industry? The very simple or basic advantages I would say is number one, that it's open 24 hours a day. So it's an opportunity for you to make money anytime you feel comfortable, or when you finish with your daily activity or your job, you can go home and then trade the market and make some money for yourself. But due to the fact also that it has very tight spreads, so compared to stocks, so it's very, very much inexpensive or cheap. And also it is margin based. So it comes to the point whereby you can use leverage to increase your earning potential. That is the advantage of trading the forex. And finally, I'd just like to specify that foreign exchange trading, it's a $4 trillion a day industry, and it comes with high risk of not only making income or making money, but also losing everything you've invested or whatever money you have in your brokerage account. You have there's 99.9% certainty you can lose everything up at the split of a second. So always beware about that if you decide to go down this path. The first thing you have to know when you decide to become a foreign currency trader or a forex trader is that currencies are traded in pairs, right? For example, you will see the euro, US dollar, you'll see the British pound, Japanese yen, you see the Australian dollar, US dollar, like that. So it's always traded in pairs. Now, the currency which is on the left is normally known as the the quote currency, and I'm very sorry. The currency on the left is known as the base currency, and the currency on the right is known as the quote currency. That's as simple as it is. So if you see euro, US dollar, euro, which is on the left, is the base, USD, which is on the right, is the quote. If you see British pound, Japanese yen, British pound on the left is the base, Japanese yen on the right is the quote. That's as simple as it is to understand. Another concept which is very important for you to understand if you decide to go down this path is what is the bid and the ask price. And normally these are prices which are normally provided by the broker or the market maker. And because they handle this transaction, so they determine this price. And normally the bid price is normally the number of quote currency you will receive when you sell 1 unit of the base currency. And the ask price is how much of the quote currency you will receive in order to buy 1 unit of the base currency. And the ask price is normally higher than the bid price. And the difference between the ask and the bid price is normally the profit, or you can call it the spread, which the broker takes for facilitating the transaction. Another thing you have to understand if you decide to trade these currencies or become a forex trader is PIP, pip basically it measures the increase or the decrease of the currency being traded, and 1 pip is normally 0.0001 US dollar, depending on the currency you are trading. When somebody says I am long, basically they have bought positions in a currency pair, and when somebody says I am short, means they are selling a currency pair. Only when you close, say for example, you are long a particular currency pair, you close that position by selling it. And if you are short a currency pair, you close that position by buying it. And that position becomes closed in your books. So how to make your first trade is very simple. You have to get a reputable broker who is regulated and in the market. And then you can start by opening a demo account, or you can call it virtual account or a paper trading account. Once that is done, you then now create a watch list, which can be 2 or 3 currency pairs which you want to observe them, their movements, understand them, chart them, to know how this currency pair moves before you can now move into it fully. Now, there are 2 kinds of traders. You have the intraday traders who will hold trades for less than 24 hours. And then you have the intraday traders who will hold trades for 24 hours or more. And most of these traders use 2 techniques. It can be a technical analysis. Basically, they focus on the chart and what the technicalities of the chart and the trading software. And you have the fundamental traders. These are people who focus on the economy and news when they are trading. Now, once you have certain about this basic concept, the next phase will be about order types. What kind of orders you can place using in the market. So once you have determined your broker and you have the trading software you are looking for, it can be MT4, MT5, it can be CTrader, whatever it is, TradingView, whatever it is you are using for trading. The market orders is the first order type, which is basically an immediate execution. So you are buying now, you're selling now. And then you have limit orders, basically, which are extended, which are executed only when certain price conditions are fulfilled. You can say buy when price get to this price level, or sell when price get to this price level. Those are our limit orders. And then there's take profit orders, basically says when price gets to this level, take profit. And there's stop loss orders, which says if price gets to this level, if I'm still in the position, close the position. You are stopping your loss. That's all. And just to conclude this, I'd like to talk about CFDs, which are basically contracts for difference. And basically a CFDs, what they do is they allow you to trade price movements on financial commodities without owning the instruments. And what are financial commodities? They can be stocks, they can be indices, they can be commodities, they can be currencies. These are financial instruments which you can trade them as CFDs. Now, profit or loss is the difference between the price when you open a position and the price when you close the position. And I just want to remind you that you can only use or risk only what you can afford to lose when you go into this business. What are the advantages for trading CFDs or for trading Forex? Profit on the rise or fall of the market. You make profit depending on your position. You can use leverage. The transaction cost is very low. You have flexible instruments, over 16 currency pairs you can trade on a daily basis. And in terms of CFDs, you have over 8 or more different CFDs or instruments you can trade. And it is very fast, so you can trade now, open a position now, close it now. There are people who make thousands of dollars in this matter of under 30 of minutes in this market. So that is all I have for you for this first edition in terms of Forex trading basics. If this is informative or there are certain topics you would like us to discuss about or for me to share on this channel, I would definitely like to hear from you. Please comment, share, like. Have a wonderful day. The purpose for this channel is basically, I call it World Redeemer, because I want people to be able to redeem their world and definitely take advantage of the digital market, take advantage of the digital economy, because that is where we are going for. That is, online trading is basically the future.